at the April meeting, such an increase could be warranted at any later meeting depending on how the economy evolves. Let me emphasize again that today's modification of the forward guidance should not be read as indicating that the committee has decided on the timing of the initial increase in the target range for the federal funds rate. In particular, this change does not mean that an increase will necessarily occur in June, although we can't rule that out. As we noted in our statement, the decision to raise the target range will depend on our assessment of realized and expected progress toward our objectives of maximum employment and 2% inflation. We continue to base that assessment on a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial and international developments. We anticipate that it will be appropriate to raise the target range for the federal funds rate when the committee has seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. Once we begin to remove policy accommodation, we continue to expect that, in the words of our statement, even after employment and inflation are near mandate-consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. This guidance is consistent with the paths for appropriate policy reported by FOMC participants. Compared with the projections made in December, most participants lowered their path for the federal funds rate, consistent with the downward revisions made to the projections for GDP growth and inflation, as well as somewhat lower estimates of the longer-run normal unemployment rate. The median projection for the federal funds rate is just below 2% in late 2016 and rises a bit above 3% in late 2017. The median projected rate in 2017 remains below the 3.75% or so projected by most participants as the rate's longer-run value, even though the central tendency of the unemployment rate by that time is slightly below that of its estimated longer-run value, and the central tendency for inflation is close to our 2% objective. Participants provide a number of explanations for the federal funds rate running below its normal longer-run level at that time. These include, in particular, the residual effects of the financial crisis, which are likely to constrain spending and credit availability for some time. I'd like to emphasize that these forecasts of the appropriate path of the federal funds rate are conditional on participants' individual projections for economic output, inflation, and other factors. But our actual policy actions over time will be data dependent. Accordingly, if the expansion proves to be more vigorous than currently anticipated, and inflation moves higher than expected, then the appropriate path would likely follow a steeper and higher trajectory. Conversely, if conditions were to prove weaker, then the appropriate trajectory would be lower and less steep. Finally, the committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. The committee's sizable holdings of longer-term securities should help maintain accommodative financial conditions and promote further progress toward our objectives. Thank you. Now I'd be happy to take your questions.
Howard Schneider with Reuters. So I just Howard Schneider with Reuters. Hi, thank you. So there's been this pretty consistent reference to expectations of above-trend growth over the last few months. Now we're seeing growth downgraded in the context of very explicit references to international and external conditions, weak export growth, oil dragging down inflation, and your own comments now on the dollar. So my question is, doesn't this indicate that the Fed's facing a tougher time, kind of going it alone, decoupling from the rest of the world than perhaps you expected last fall when this first started to be an issue?
Well, it looks like from incoming data pertaining to the first quarter that real GDP growth has declined somewhat below where it was for the last several quarters of last year. And that's really why the committee indicated that growth is moderated somewhat. There has been a slight downgrading of estimates of growth for this year. You mentioned the dollar. We noted that export growth has weakened. Probably the strong dollar is one reason for that. On the other hand, the strength of the dollar also in part reflects the strength of the U.S. economy. The strength of the dollar is also one factor that, as I noted, is holding down import prices and, at least on a transitory basis at this point, pushing inflation down. So we are taking account of international developments, including prospects for growth in our trade partners, in making the forecast we have here. Nevertheless, it is important to recognize that this is not a weak forecast. Taking everything into account, we continue to project above-trend growth. We continue to project improvement in the labor market. By the end of 2015, the central tendency of the participants is they're looking for an unemployment rate that will be down to 5.0 to 5.2, which is consistent with their estimates of its longer-run normal values. So we do see considerable underlying strength in the U.S. economy, and in spite of what looks like a weaker first quarter, we are projecting good performance for the economy.
Marty Krutzinger, Associated Press. The policy statement today talks about one of the prerequisites you'll need to start raising rates is to be reasonably confident that inflation, your inflation target will be met at 2%. But that is coming out at a time when you've lowered your forecast on inflation, which I would think would make you less confident about it. What is it going to take to make you reasonably confident about inflation?
So I don't have a mechanical answer for you. There is no single thing where I'd say we must see such and such in order to achieve that level of confidence. We will be looking at a wide array of data. Now, we also want to see continued improvement in the labor market. And a stronger labor market with less labor market slack is one factor that would tend to, certainly for me, increase my confidence that as slack diminishes, that inflation will move up over time. Other things I will be looking at, of course, the inflation data, but as we said, we expect inflation to remain quite low because of the depressing influence of energy price declines and the dollar. But we will be looking at the inflation data carefully to see if we can interpret, for example, low levels of inflation, if we see that, which we expect, as reflecting those influences. We will be looking at wage growth. We have not seen wage growth pick up. We may not see wage growth pick up. I wouldn't say either that is precondition to raising rates, but if we did see wage growth pick up, that would be. We'll be watching inflation expectations. Survey measures have been stable. I expect that to continue. but we will be watching it carefully. And market-based measures of inflation compensation have fallen. They're low. If they were to move up over time, that would probably serve to increase my confidence. But there are a wide range of things that we will be looking at, including further improvement in the labor market. So there's no simple answer. This is a judgment that the committee will have to make.
John Hilsenrath from the Wall Street Journal. Chair Yellen, the famous dot plot that we always talk about showed that officials' expectations for where interest rates are going to end the year in 2015, 16, and 17 have come down fairly notably. I wonder if you could explain to us your analysis of why those estimates are coming down, and specifically, is it a reflection of what's changed, and is it a reflection of the changes in the Fed's economic forecast, or a change in the way the Fed is reacting to the economy that it sees, its reaction function?
So it's always hard to know exactly why each participant has written down the forecast they have, but certainly there are changes in the assessments of the economy and forecasts for the economy that would point in the direction of downward adjustment in the funds rate path. For one thing, you do see meaningful downward adjustment in the inflation forecast, certainly for this year. In addition, importantly, a number of participants have marked down their estimates of the normal longer-run unemployment rate. So that range has moved down noticeably from previously it was 5.2 to 5.5, and it's now moved down to 5.0 to 5.2. And downward revisions to the longer-run normal unemployment rate in a way suggests that participants are seeing more slack in the economy now than they previously did. So I think both of those things would point to downward revision in the funds rate path.
Sam Fleming from the Financial Times. The experience of some other central banks, notably Japan, Sweden also, suggests that tightening early when you're at the zero lower bound can be a risky process. The risks of tightening early can dramatically outweigh the risks of leaving things a little longer. I wonder if you could comment on that international experience and explain how that's influencing the debate in the FOMC at the moment.
Well, when an economy is operating at the so-called zero lower bound, it creates a situation where there are asymmetric possible if the economy proves stronger than is expected to respond to that by tightening policy. If there are adverse shocks to demand that tend to push inflation and economic performance in an adverse direction, it's not possible to lower rates. Of course, that's a reason why for a number of years we engaged in active asset purchase programs. So there is a situation there of asymmetric risks, and it does point in the direction of waiting longer to raise rates. But I would say that this is an influence that we, and a set of considerations that we've long been aware of and have been taking into account, so that it's not something that just comes into play now. It is a reason that we have held rates at 0 to 0.25% for now roughly 6 years. So we are seeing an economy that's growing above trend. The labor market is improving. I think some of the headwinds that have long been holding the economy back are beginning to recede, which is a reason that the committee wants to be able to evaluate incoming data and consider when it may be appropriate to finally to finally raise rates, but that is a consideration with
metrics on unemployment about when it would move with rates. Is it now policy to keep the market guessing? And is it thought that you'd have better policy and economic outcomes from less